Winter brings relentless freeze-thaw cycles. When water slips into a crack in an aging shingle and freezes, it expands, physically tearing the material apart. Your roof serves as the primary shield defending your home's framing, electrical systems, and insulation. Its function is structural, acting as the first line of defense against deterioration that can compromise the entire building. Ignoring early warning signs allows water to intrude deeper into the house. A simple missing shingle or a minor leak quickly turns into saturated insulation, rotting wood, and ruined drywall, turning a targeted exterior fix into a massive interior renovation. Stopping this deterioration usually costs $15,000 or more. Paying that entirely in cash fixes the physical damage immediately, but it drains your emergency reserves, leaving your household highly exposed if a medical bill or major car repair hits next month. Financing can bridge this gap. It protects your property while keeping your cash liquid. But signing a credit agreement without understanding the terms introduces entirely new financial risks to your household. You are caught between two distinct threats: the physical deterioration of your property and the financial hazard of taking on thousands of dollars in long-term debt. This quadrant maps your predicament. The vertical axis is roof condition. The horizontal is cash flow. Top right, paying cash fixes a failing roof but drains your savings. Top left, financing secures a stable roof right now without wiping out your bank account. Here is where the roofing industry often sets a trap. Many contractors will steer your focus entirely toward an ultra-low monthly payment. They use that small number to distract you from how much the debt will actually cost you by the end of the term. To make a safe financial decision, you must strip away the marketing jargon and evaluate the true total cost of borrowing. This allows you to build a comprehensive plan that protects your long-term wealth. Lenders know how to make a large debt look small. By stretching a loan out over 10 or 15 years, they create an artificially comfortable monthly payment that easily clears your checking account. This comparison matrix reveals the math behind that marketing. We have two identical $14,000 roof replacements. In column A, you finance the project over a 3-year term. The monthly payment is high, but the total amount you pay in interest remains relatively low. In column B, you stretch that exact same loan over a 10-year term. Your monthly payment is cut in half, but watch the total interest line. It expands rapidly. That highly advertised, easily affordable 10-year payment actually costs you thousands of dollars more by the time the loan is finally closed out. Neither loan structure is inherently wrong. A longer term can help you survive a tight month. But you must make your choice based on what the roof will ultimately cost you in total, not just what fits into today's budget. If you optimize strictly to get the lowest possible monthly payment, you are choosing the fastest, most certain way to overpay for your roof. Another major industry trap is the promotional offer, typically advertised as same as cash or no payments, no interest. The immediate benefit looks excellent on paper. You get a new roof installed today, and you keep your emergency cash completely liquid for a full year without paying any penalties. The danger is buried in the contract under a specific term: deferred interest. The interest isn't canceled, it is simply waiting. If you miss the payment window by a single day or leave a tiny balance unpaid by the exact expiration date, every dollar of that deferred interest from day one is retroactively applied to your account as a massive financial penalty. Standard loans have their own pitfalls. Evaluating a loan strictly by its advertised interest rate is risky, because lenders often compensate for a low rate by packing the agreement with origination fees, dealer fees, and document charges. You must demand the APR, or annual percentage rate. It calculates both the interest and those hidden fees. Ignoring the APR and the fine print on promotional deadlines guarantees you will pay costs you never planned for. Making a logical, mathematically sound financing decision requires evaluating 4 specific numbers simultaneously. This simple checklist displays the exact metrics you must demand from any contractor before signing an agreement. First is the project price, and second is the APR. These represent the base cost of the physical roof, plus the comprehensive cost of borrowing the money. Third is the loan term, and fourth is the total repayment amount. Seeing the length of the debt directly dictates the final, unavoidable price tag of the project, but those financial numbers mean nothing if the physical estimate is wrong. Your approved loan amount is only as accurate as your contractor's initial inspection. Do not sign a rigid financing agreement before the contractor has thoroughly evaluated hidden, code-related issues like rotted decking and poor attic ventilation. If the crew tears off the old shingles and discovers extensive hidden rot mid-project, your original loan amount will fall short. You will be forced to pay the expensive difference entirely out of pocket. A financing agreement is useless if the roofing scope changes. Financial safety requires hiring a meticulous, transparent contractor who documents everything up front. Once you know how to avoid the hidden traps, you can tailor your financing strategy to your specific cash situation. This decision tree maps out the 3 most reliable paths based on your primary goal. If cash is extremely tight and you need an emergency fix, prioritize the shortest survival term possible. Guarantee there are no prepayment penalties, so you can aggressively pay down the principal and escape the debt quickly. If you have cash but want to stay liquid, you are paying for liquidity. Run the math to ensure the APR doesn't exceed the actual value of your financial security. If you are using a loan to afford better, weather-resistant materials for a premium upgrade, ensure the total loan interest doesn't completely wipe out the long-term return on investment of the upgraded roof. The correct path is determined entirely by your household's timeline and cash flow durability, not a contractor's aggressive sales pitch. A monthly payment measures what fits into today's budget. The total repayment amount measures the true permanent cost of your roof. Replacing a roof with a loan means you are making 2 massive decisions simultaneously: entering a binding credit agreement and choosing a reliable contractor. Navigating this process requires a trusted partner who provides clear, written estimates and honest financing guidance without high-pressure tactics. MasterRoof Kettering offers a transparent alternative to industry smoke and mirrors. We are dedicated to making your replacement project clearer and safer, not more confusing. If you live in the Kettering area, click the link below to contact MasterRoof Kettering today. Get an honest roofing estimate and a financing plan built to protect your long-term financial health.